Welcome. This is Brook Hollow TV. I'm Scott Drake. My guest is Brian Michaels. He is General Counsel with Brook Hollow Financial. Welcome back, Brian.
Thanks, Scott. Good to be here.
Brian, we're talking about an article you've written recently for this edition of Trial Lawyer Magazine regarding something that is only available to contingent fee lawyers and can be very, very powerful and flexible, helping you structure your retirement, providing tax deferral. I think I've covered some of that. Can you talk about the article?
Sure, Scott. We were fortunate to have an article published in the Trial Lawyer in the most recent edition, and it's really all about structuring, deferring through the use of a structure, contingent attorney fees. So it's available only to trial lawyers who have contingency fee agreements with their clients. The importance of this article is that fees have been able to be structured for a number of years, but only with fixed annuities. So the only return that the attorney could get was a fixed annuity return. And many attorneys are interested in structuring their fees, but they really wanted to be able to have a market-based return. And what we did was develop a product in the process to be able to do that. So this article is all about how and why and the benefits of being able to do a structure or defer a contingent fee through a structure where the return or those future payments are based on a managed portfolio of different assets. And those assets are picked by the individual attorney.
Well, one of this product's major and most attractive components is tax deferral. Can you explain some of that?
Yeah, I mean, it's really straightforward. You're taxed for cash basis taxpayers, which I would say virtually every attorney is, in the year that you actually receive the cash, actually receive the fee. So if the attorney takes the whole contingent fee and say this year, it's going to flow into their tax return and be taxed. When it's deferred through the use of a structure, the tax is spread out because the income is spread out into the years where it's actually received. And there's complete 100% flexibility of the attorney's choosing as to how that is spread out and over what period of time. For instance, we've had some where it's been deferred for 5 years, paid out over 15 years. We completed one just yesterday where the deferral is for 10 years and then it's paid out over the following 10 years. Sometimes the payments start the following year. I mean, it all depends upon what the attorney wants to do or what they want to accomplish.
Well, Brian, because of the uncertainty of a future tax law, are there any caveats you'd care to talk about?
Well, the caveats. I mean, as far as the tax landscape, Congress seems to be always changing or always talking about changing tax rates and that sort of thing, and we get into some nice discussions with attorneys about those issues. But what we talk about and what we like to point out or suggest is that that's something that you can't control. So let's talk about what can be controlled, and that is how the funds are invested. When you actually take the income, and match that to the individual needs.
Brian, can you talk about some of the rulings that may have led to why this actually can work?
Yeah, from a tax standpoint, nothing has really changed. For a brief background, attorney fee structures or deferring the fees has always been, historically was made available kind of as a derivative of structured settlements for their clients, and it grew out of that practice. And then back in the early 90s, there was a case called Childs versus Commissioner, where the IRS, frankly, didn't like it. They challenged one of these. They lost at the tax court level. Then they lost at the IRS appealed it to the 11th Circuit, and they lost at the 11th Circuit. So the tax law, and there have been to our knowledge, there have been no rulings. Well, we know there have been no rulings, no cases since that time. So the 11th Circuit case, I think, was in '94. So it's been 94? My math is bad. 20-some years, right?
Yeah.
So, it's deeply rooted in tax law. And but the difference, and I think what you're asking, Scott, is why can we structure using a managed portfolio now versus just a fixed annuity through a life insurance company? And the answer is that the market has always been provided by life insurance companies. Nobody stepped out and developed the product for the need for the attorneys, and we said, now the time is right. This is what we need to be doing, and we did, all of the research, all of the development, and have brought it to market, and it's a lot of interest in it.
Brian, we know we can read this article in Trial Lawyer Magazine. Can we get a copy anyplace else?
Yeah, we do have a copy of the article available on our website, and that would be brook-hollow.com. And I think right there on the front page is a link to the article. So feel free to download it, have a read, and if you have any questions, give us a call.
My guest is Brian Michaels. He is General Counsel at Brook Hollow Financial. Brian, thank you.
Thanks a lot, Scott. Appreciate it.
You're watching Brook Hollow TV.